Yes, good morning, good afternoon, whichever time you're watching this video. Welcome to another session of Principles of Accounts. In this session, we're going to look at partnership accounts and introduction. Please sit back, relax, do not sleep, and watch this video clip and take your notes as is possible. At the end of this video lesson, students will be able to understand exactly what a partnership is, distinguish between limited partners and the ones with unlimited liability, know what the main features of a partnership agreement should be, realize what will happen if no agreement has been made to share profits or losses, and to draw up the final accounts of a partnership. Now, what is a partnership? A partnership has the following characteristics. It is formed to make what? Profits. It must obey the law as given in the Partnership Act of the Caribbean Commonwealth. And 3. Normally, there can be a minimum of 2 partners and a maximum of 20 partners. That is it, my friends. Alright, we look at something called limited partners versus unlimited partners. What is the difference between limited partners and unlimited partners? On the screen you can see that limited partners are not liable for the debts. Liability is limited to the capital they have put in. They can lose that capital, but they cannot be asked for any more money to pay debts. Unlimited partners now are liable for debts because, if necessary, partners may be forced to sell all their private positions to pay their share of debts. Let me give an example now. If you are a limited partner, it is only the money that you invest you will lose. You won't be losing your house, car, any private position. However, if you are an unlimited partner, you will lose both the capital and your private positions. So there's a main difference, my friend, between limited partners and unlimited partners. Alright, look at some important terms now. Partnership. A partnership is a firm in which 2 or more people are working together as owners with a view of making what? Profits. A limited partner now is a partner whose liability is limited to the capital he or she has put into the firm, as I said before. Interest on capital now is a term used. It's an amount at an agreed rate of interest which is credited to a partner based on the amount of capital contributed by the partner. So therefore, interest on capital is an amount which is worked out based on the amount of capital that the particular partner has contributed, my friends. This will be demonstrated to you later on in the video clip, my friends, video presentation. Other important terms: interest on drawings. This is an amount at an agreed rate of interest based on the drawings taken out, which is debited to the partner's account. Credited and debited. Credited, something called like debited and credited. So therefore, interest on drawings are added to net profit, while interest on capital is subtracted from what? Net profit, right? Yes. So in your appropriation account, you will add interest on drawings and minus interest on capital, quite so, from net profit. Alright, partnership salary now is an agreed amount payable to a partner in respect of duties undertaken by that partner. Something called a fluctuating capital accounts. Here, this is capital accounts whose balances change from one period to the next. Another important term is the fixed capital accounts. These are capital accounts that consist only of the amounts of capital actually paid into the firm. Capital accounts that consist only of the amounts of capital actually paid into the firm. Alright friends, welcome to another clip of how we do accounts. In this clip we will look at profit and loss sharing ratios. Yes, profit and loss sharing ratios. It's an example. Suppose the capitals are as follows: Allen $2,000 and Bess $1,000. How would we share them? See, although partners can in fact agree to share profits or losses in any ratio that they desire, it is often thought by students of accounts that profits should be shared in the same ratio as that in which capital is contributed. So, for example, in this case, Allen contributes 2,000 and B contributes 1,000. Many people would share profits in the ratio of 2/3 to 1/3. So what would happen is that you would add the 1,000 and the 2,000. You would place 2,000 over 3,000. You would, in that case, you will get what? 2/3. And 1,000 over 3,000 is what? 1/3. Okay, divide. You will cancel out the zeros then. So you would have 2/3. Many people would share the profits in the ratio of 2/3 and to 1/3, even though the work to be done by each partner is similar. Now, in this example, the division of the first 2 years' profits on such a basis are shown right here as follows. So you notice that 2/3 to 1/3. So 2/3 of 1,800 is 1,200, and 1/3 of 1,800 is 600. So 1/3 times 1,800. Same thing. 2/3 of 2,400 is 1,600. 1/3 of 2,400 is 800. 2/3 of 3,000 is 2,000, and 1/3 of 3,000 is 1,000. 2/3 of 3,000, 2,000. 1/3 of 3,000, 1,000. 2/3 of 3,600 is 2,400, and 1/3 of 3,600 is 1,200. Now, it can be seen that in total, Allen would receive 9,200 and B would receive 4,600. Therefore, Allen would receive 4,600 more than Beat, right? So, however, to treat each partner fairly, the difference between the two shares of profit when the duties of the partners are the same should be adequate to compensate Allen for putting extra capital into the firm. Some might feel that $4,600 extra profits is more than adequate for this purpose as well. Alright. To overcome the difficulty of compensating for the investment of extra capital, the concept of interest on capital, which we said before, my friends, is what? What do you say interest on capital is again? Anybody tell me? It is an amount at an agreed rate of interest which is credited to a partner based on the amount of capital contributed to that partner. So in the next video, in another video clip, we'll look at what? Interest on capital, my friends. So in order to avoid this problem of compensation, there's a concept that was devised called interest on capital, which will be shown or demonstrated to you in the next video clip. Alright friends, what is happening over here is that we are looking at this account over 5-year period. So it's year 1, year 2, year 3, year 4, year 5. It's the total. Alright, remember we talk about interest on capital. What is interest on capital again? Can anybody say it? No? By that? Interest on capital is an amount which is credited to the what? To the partner's account. That means it will be subtracted from what? Net profits. Alright. If the work to be done by each partner is of equal value, but the capital contributed is unequal, it is reasonable to grant interest on partners' capitals. This interest is treated as a deduction prior to the calculation of profits, and their distribution according to the profit sharing ratio. My friends, the rate of interest is a matter of agreement between the partners, but it should equal the return they would have received if they had invested the capital elsewhere. Now take for example again Allen and Beat's firm, but now they are sharing the profits equally after charging 5% per annum interest and capital. So their profits will be shared what? Equally. Please note, profits will be shared what? Equally after they would have charged 5% of interest and capital per annum. Remember now that Allen's capital is what? 2,000. Is right? Allen's capital is what? $2,000, while best beat is best beat capital is $1,000. So we're going to say, all right. So these are the profits: 1,800 for year 1, 2,400 for year 2, 3,000 for year 3, and 3,000 for year 4, and 3,600 for year 5. Those are the net profits. Now we're going to charge interest on capital. Therefore, we say 5%. We want to say 5%. Which is 5 divided by 100. 5 divided by 100 times 2,000. So 5% of 2,000 is what? Is 100. Now we're going to find 5% of 1,000. So we're going to say 5%. 5 divided by 100 times 1,000. So it will be 50, right? And and it said that they would share 5%. It would be they would charge interest on capital at 5% per annum. That means every year they'll be charging 5%. So every year, in this case, you would have 100 for interest on capital for Allen and 50 for Beat. So at the end of the 5 years now, it would be 500. The total of interest on capital would be 500 for Allen and 250 for Beat, right? However, in this case, you can realize that Allen has received $250 more than Beat. This we call an adequate return. Because what? Allen invested an extra $1,000 in the firm for what? 5 years. So now she's getting $250 more than what she has invested. So this is what we call an adequate return in the partner's estimation. So this part is called the interest on capital. This interest on capital now is deducted the 150. You're gonna add 150 plus 1,000. 150 will be deducted from 1,800, and the remainder will be shared what? Will be shared equally. Why do you say why are we going to share equally? Because what? It says the Allen and Beat are sharing profits equally after charging 5% per annum. So we charge 5% for the first year, right? And we say that we should less the interest on capital from the profit. So therefore we're going to add 100, and so this would be, let me put something else here. We're going to less interest on capitals. That is how it should be written. So therefore, if we could easily place a line right here, a little line, and say we're going to minus this 150 from 1,800. How much would we get? So we should have 1,800 minus 150. that would equal to what? 1,650. Now we see that we are showing profits equally, right? Therefore it therefore means that we're going to say half, right? So Alan will get half of the remainder and B to get half of the remainder, because half of the profit, because this is called profit. This is profit, in this case profit. So this is the new net profit. Basically we call it a new net profit. So new net profit is 1,650. So Alan will get half of that. So we want to, so it will be 1 over 2. 1 over 2, work it out. 1 divided by 2 times 1,650 equal to 825. In this case it will be the same, right? Yeah, it will be the same. How to be the amount, my friends? In this case the amount would be 2,400 minus 150. You have 2,400 minus 150. That would be equal to 2,250. In this case it would be 3,000. We say that we will have 3,000 minus 150 again, and again 3,000 minus 150. That will be equal to what? 2,850. 2,850. And this is the same thing, 2,850. And then this now. Then we're gonna have something called we're gonna have 3,600 minus 150 again. 3,600 minus 150 would equal to 3,450. And this, all these will be shared in half, which will give you these figures. So if you add them together, you'll get this. If you add these two together, you'll get this. If you add these two together, you'll get this. And if you add these two together, you'll get this. And when you add up everything across the board, you get a total profit for Alan would be 6,525, and same thing for other person. Now at the end of it all, we'll have a summary right here. With a summary Alan beat. So interest on capital for Allen would be 500 and 250. So you're gonna add, then you're gonna add the balance of profits to add the profit to the interest on capital, and you get this figure right here. So see the difference there? What's the difference here? Can anybody see the difference, my friends? I can see it. Let's work out the difference. We have 7,025 minus 6,775 equal to 250. So 250 is the difference. Why? Because Allen received 250 more than Beat. So 250 is the difference. That's it for interest on capital, my friends.